All right. Hope everyone's having a good Monday. One of the things I'm going to try to do is do a quick recap of some of the ideas in the Lumina ledger. We cover quite a bit of ground in that, like dozens of pages long. I think it feels like that when I write it. But first off, I want to introduce a new member of the team. Stein, why don't you go ahead and introduce yourself?
Yeah, sure. Thank you. So hi, everyone. Great to be here. I've been with Lumina for 4 weeks now. This is my 5th week. I'm a research analyst and a trader working for Lumina now. And to tell you guys a bit more about myself, well, I have been investing in trading for quite some time now, about approximately like 2.5 years ish. And the way I met Ram is quite funny actually, because I saw his Twitter account after I listened to a podcast called the Nifty Alpha on Spotify. Ram was a guest there. And I was like, this guy is quite smart, because I was into crypto and trading there at first. And then I was like, this is a guy from traditional finance, which is smart and has a view about themes and higher level ideas of the world. And he knows how to action on that. So I was like, I need to give this guy a follow. Then I read the newsletter from Lumina each week on Sundays, the Lumina ledger. And then I was like, I need to get into contact with this man. So I DM'd him a bit, and we were DMing through X and talking about his career as a philosophy student, right, Ram? Because I'm also interested in that, in the philosophy side. So we talked a bit about books and markets in general. And then I saw that there was a Telegram group from Lumina, and I chatted a lot in there with some of these members, and I shared charts. And Ram saw that I was very active, and he told me like, I need to get into contact with this guy, and we need to get into contact a bit. So then he reached out through Twitter, actually, again, back on Twitter. And then we had a Zoom call, and that's already like 5 weeks ago, of like 4 hours long. And then we went off from there, and now we're here 5 weeks later, still working together.
It's a great story. We're having a lot of fun now. Stein's got a tremendous initiative, incredibly bright. So we look forward to doing this more often. Stein's like our trader here, and it's been a lot of fun. But it's a good example of initiative and shooting your shot. I saw Stein, as you mentioned, was active in the group. I was like, who is this guy? I got to jump on a Zoom with him. We did that on the weekend. I said, can you start tomorrow? So here we are.
Sure.
So we're going to cover a lot of ground today. I want to talk about consumer discretionary, which I think is at a really quite interesting inflection point. But we're going to talk about semiconductors, small, are we there yet? Talk about crypto, Bitcoin. We could talk about a few other topics there, Stein, as well, right? Jim Bianco, I saw you posting there's such thing as a Trump bump. I think is wrong. We talk about that too. We're going to try to cover the main ideas in 40 minutes or so. And by the way, if there are key topics or questions you want us to discuss, to the extent that we have a view on it, I'm happy to share. Just drop it in the comments. So let's start off with the newsletter. Again, I recommend folks subscribe to this if you haven't. I'm not going to go through all of it. It would take too long. But I do want to highlight a few things. One is last Tuesday, I had a What's on Your Mind Tuesday evening. I've never done a Tuesday evening solo What's on Your Mind. But it was like, look, we think the market's, we've had a melt up, and it's not time to chase, and there's risk ahead. Expected to be sometime last week. Surprisingly, like the very next day, and obviously markets have tanked and gone in I believe, entering a corrective phase. You can see that chart there. And some of the reasoning around that is highlighted in the newsletter. I recommend you all take a look at that. And we also saw some incredible news this weekend where the sitting president announced they're not going to do re-election. That's an incredible change. 1 week ago, the odds of that were 37%. So extraordinary times. Small caps as well. We're going to talk about small cap rotation. Go ahead. Yeah.
By the way, one thing I wanted to say to the audience, to the people that are looking now and are here for instance, the first time seeing this newsletter, this is basically my entry into the Lumida ecosystem. This is the way I found about Lumida. And I would really advise you guys to put this on like your to-do list for every Sunday, because when you read this, you're truly prepared for the week ahead, and you don't need to read 1,000 different articles on Seeking Alpha, investing.com, CNBC, whatever you're looking at. I think this summarizes everything we do in the week. So we listen to all the podcasts, we read all the news articles, we cover all the charts, all the factors. Everything that we cover over the week is being summarized into this newsletter, and it's free for you to read, right? So I think it's a must.
I guess, Stein, to your point, do you want to like recap what our process is daily and weekly, and kind of what you've learned over the last few weeks?
Sure. Yeah. So when I got in the first week, it was I had to find a bit of my rhythm in the company, but now that I really know what my job is, I could go over that. So what we do is from Monday, Tuesday, Wednesday, Thursday, Friday, so 5 days a week, we have a call, you, me, and another analyst. You are from America, of course, and we are from other parts of the world that are ahead of the time. I'm from Netherlands, and the other analyst is from another part of the world, and we are ahead of you. So when Ram wakes up in the morning, we have all the research prepared, and then we go over the research we have done, and then we discuss our higher level themes. So what are we looking at? Are we looking to get into semis, or are we waiting to get into semis? And then we also do projects around that. So Ram, for instance, gives me a project where he says like, hey, Stein, could you check when NVIDIA bottomed last time? When did semis bottom last time? How does that correlate with the 10-year? Those kinds of things. And then we hope to use the answers to those studies in the future, if that makes sense for you guys. Because when, of course, you can do studies, but the most important thing in this job is actually applying your answers to these studies and applying your answers to these questions, because we also like to work a lot around questions. So yeah, that's basically what we do. And then after the call, we do further research, and then in the morning we prepare again for the next call. And this way we are just on top of the market.
It's full cycle. It's great.
Yeah.
So some other quick highlights here. So small caps, we talked about how we think this is a continued rotation. You know, we saw the most overbought reading for any major US index. Now, you know, your first instinct might be, hey, look, that's prone for mean reversion. We think that's a breadth for us, and it means more moves ahead. Although this week, which we wrote about in the newsletter, we think we get a slight, somewhat of a retracement, and then a continued push ahead. And we think this week you get a bounce in semiconductors. And that's actually what we're seeing today in the Monday morning. Talk about small caps retracing, and on another thing we've written about in this newsletter, by the way, are some of our picks in small caps and mid caps. But where should we go, Stein? What's the next topic?
Let's go to this document and let's actually discuss indeed the small side of, because we covered that IWM is pulling back, so that's small caps, and then that we expect the QQQ and tech to bounce in the short term. So I could share my screen in the document we will present.
Yeah, go for it. While you do that, you know, last week we talked about how ASML and other semis have pulled back quite a bit, and it was really a sharp and swift correction. So one of the open questions is, given the speed and velocity of that correction, does that reduce the time in which it takes for markets to settle out here? In fact, you've seen ASML, you know, is at levels not seen since early February. And it's really quite interesting because, you know, we were buying ASML in October of last year, and then it became consensus at the IRSON conference. It's gone nowhere since, in fact, corrected since then.
Yeah.
And now for the first time, it looks interesting, although it's not as cheap as it used to be during the last semiconductor cycle in the 2015s and 2016s.
Agreed.
Go ahead.
Yeah, like you said, the speed, you guys can see that here in this chart, because on the top you can see the current situation. This is what we are in now, and you can see this is charted or measured from the 10th of July, and we're at the 22nd now, so that's a 12-day period, and you can see the correction on the Nasdaq is already minus 5.5%, And then when we go lower, you see the last local rate cycle. When that happened, this is the lower one is measured over a period of 1 month-ish, and you can see that the correction on the Nasdaq was -7%. So you can already see that this correction has been way more speedy, like Ram said, but here you can just see it with data, than the previous one. What we should go. Oh, you would like to chime in there?
Yeah, look, I think it's a notable point, and we don't think that this correction exceeds 10% for the broad market indices because there's strong earnings growth for these secular trends. That's number one. Number two, there's still cash on the sideline. Some of this is washing off the excess from excessive speculation. We saw like record call option buying in these names, and Citadel has a nice rug pull here on those folks. You've obviously got negative seasonality now that the first 2 weeks of July are behind us, going into August and September, very much like the identical setup as last summer, actually.
Yep.
So we'll stay on top of this. Why don't we go to consumer discretionary? I think this is actually a more interesting area of the market. Look, there are probably 3 areas in the market that are interesting. One is like semiconductors. That's part of the AI CapEx receiver thesis. That's one. Second are small caps. And then third now is consumer discretionary.
Yeah.
So, as you know, we've been bearish like on Lululemon and these retailers for a while. Like the retail sales reports have been awful, showing 0% growth for 6 months in a row. But we actually changed our view and started buying Lululemon last week and bought some more this morning.
Yeah.
But go ahead, Stein.
Yeah. So when we take a look at discretionary, the way we got flagged on discretionary actually being good buy is mainly by our reads on the Bank of America reports, which I and the other analyst and Ram also read almost each day of the week. And in the Bank of America report, we first of all saw that the consumer is not as weak as many of us thought. And also for the second half of this year ahead, the consumer is likely to pick up even more strength. And then on the chart side, because we always like to both have the data in numbers and then the charts. When you look at charts like Lulu and Lululemon and ULTA, you can see they are actually bottoming out. Looks like sellers are weak.
Nike and Starbucks as well. We should cycle through a few of those charts. But before we do, zoom in on the bottom half, what you have here. So that's the consumer discretionary select sector ETF.
Yeah.
And
so what's interesting here is, first of all, what do we look at? We like to buy into strength, right? You like to be in sectors that have strength. You don't want to be in sectors that are bleeding out. Well, you would like to be there when there's starting to be a rotation. But for now, this is the first valid point. Consumer discretionary is just in an uptrend. And the weird thing is when you look at many of these hedge fund surveys from Bank of America as well, you see that they are underweight consumer discretionary. And I think that's very
manager survey. It's one of my favorite reports published.
Yeah, that one. Exactly. And even though they are underweight, then I think many retail investors are already neglecting the whole of consumer discretionary, even though when you just look at the single chart itself, it's in a clear uptrend. And then when we look at the right-hand side, I think that's even more interesting because this shows the potential movements and growth in the future. Because when we look at the current valuation, consumer discretionary ETF, XLI, is trading at a PE of lower than 25. And you can see in January 22nd, 2022, it traded off a PE of a little lower than 35. So that's a nice sign that there's still room to the upside to go, instead of that you're buying when a certain sector is getting exhausted or like fully valued.
One thing to point out here, so the XLY, the top two weights are Amazon and Tesla. So even though retail, right, and that's the reason why that pullback doesn't look as dramatic. So let me actually toggle through a few charts here. Let's go through, say, Lulu, and then we'll cycle to Nike and Starbucks and just what's happening in this consumer discretionary complex. And I think we're going to see it's a common theme. So here's Lululemon, right? I'm going to zoom out. It's like a 5-year view. can see, I mean, it's at the same price as it was 5 years ago, and the revenue growth is actually comparable. It's in the revenue growth, except the business is 3 times the size in terms of revenue and cash flow. So that red line there is when Lulu reported earnings, it was down 15%. We said, don't buy the dip. I think FinTwit bought the dip. It kept tanking and tanking and tanking. Then that green line is when we bought the dip. It's up 1%. Friday, unfortunately, we couldn't get into our Schwab accounts due to this whole CrowdStrike issue. But yeah, we think that's pretty interesting. Now let's go jump to, like, say, Nike. Here is, you want to get a view of, like, is there confirmation of other retail consumer discretionary? Look at Nike, up 2.6% today. This thing has gotten mauled. I mean, again, it's like it's back to like COVID lows. I mean, think about that for a second, right? Now, it's not growing as much as it used to in the past. That's why it's been compressing. This is called a growth to value transition. You've got a stock that was valued very richly. It's growing earnings at a lower rate, so the valuation is compressed. We don't own this, by the way, but the point is, here, I believe these will bottom around the same time. I believe that time is probably now, right? And the question is, you want to pick the best horse, or maybe the top 2 horses. That's Nike. What about Starbucks? So, by the way, common thing between Nike, Starbucks, and Lulu, they all have exposure to the China consumer. They've been trying to grow in China. That's hard. The consumer in China is weak. So there's Starbucks. Starbucks is not at the ultimate low, so it's actually down today, but it's kind of off. And if you look at like a 5-year chart, again, it's back to levels you haven't seen in a long time. This thing has basically gone like nowhere since like 2019. Right? I don't think I'm going to buy that either at 20 times earnings when I can find other businesses that can grow faster.
I agree. But
so,
yeah. I think the most important.
The issue.
Sorry. When you, I think the most important thing for you guys to see when you flag through these charts, it's that they're all looking like they're catching a bit. They're all slowing down to the downside. They don't have these huge movements to the downside anymore. And then when we overlay the fundamentals, so the fact that the consumer is slowing down, the fact that many of these fund managers are actually overweight, but in the last 5 to 10 days, we've seen net trading inflows into discretionary from mutual funds. I think that's just very interesting, and that you see that something is happening beneath the surface that many people are missing out in discretionary.
Yeah, actually, I'll share that view as well. This is what you're talking about. So it's a view of the current net flows across sectors. And what do you see here under consumer discretionary? The last 5 days and the last 20 days are net inflows.
Exactly.
No one's talking about that.
No, nobody.
So that's notable. We have our, that's, I think, an interesting point of confirmation that you see here. There's a lot that one could say about this chart, actually. We're not going to spend too much time on it right now. Maybe later we can double back if we have time. Obviously, you can see the tech correction here with Infotech down also, and the focus on macro products, right? Single stocks are down. People are rotating to like these macro products. It's more like macro trading. Totally. Certain factors are on, certain factors are off. Big rotations from like large growth to small caps. So what that means is people aren't positioned at the single stock level yet, which is good. There's time to get into position before people replace these less precise macro index products with more precise single stock expression.
I think it's very important what you're saying here, because as a viewer, I think one of the most important things, one of the most burning questions in your mind is, okay, all this information, this huge wave of information is nice, but how can I actually action on this? And I think when we see this, I think the most important thing that you should remember is that even though like last week or the week prior, we have seen like a 10% move in 5 days in the IWN in small caps, but you need to remember that this could be the start of a possible rotation, that you're still on time to get your entries in, to get your bids in, and that the boat has not left yet. The train has not left the station.
Yep, I agree. So, by the way, one other interesting retailer, I don't know in this, but I don't know. Like, kind of on the fence about it. Maybe I should. We'll see. But Dick's Sporting Goods. So it's a lot cheaper than all these other retailers. I like that. By the way, I call this like a boomer stock. So boomers spend money on golf clubs, and it's hard to get competition from Amazon if you need to go in store to get fitted. So I think that, Dick's is kind of an interesting business. We've been tracking it over earnings for the last few quarters. We'll continue to do so. So that's that for discretionary. Anything else on discretionary? I think one other point actually is the Citigroup Economic Surprise Index. So that index had been weakening, and it appears to have troughed and now turning back up. So I don't know, Stein, if we can pull that up real quick here. See if I can pull it up.
Sure.
So the point is, like, look, in the first 6 months of the year, like, retail sales were terrible. The economists at all these banks had high hopes for growth expectations due to the strong 2023, where you had like nominal GDP growth of 6%. Those hopes were dashed, and that creates like bifurcated market of the best versus the rest, right? That's the regime we've left, we believe. It's a new regime that's unfolding right now. So here's the Citigroup Economic Surprise Index. So what this index does is it looks at the changes in consensus expectations versus realized results. So what that means is during this upswing here in 2022 to 2023, you remember 2022, everyone thought there was going to be a recession, and then you see this improvement. That means analysts were overly bearish. They were overly bearish, and the U.S. outperformed. This is, of course, one of the reasons why you had a significant rally in U.S. equities. And here, again, you've seen this downdraft, and you see it. If you zoom in, squint a bit, you can see it's curling back up again. I think this is just more evidence that a lot of bad news has been priced in, and we are setting up for a rotation to quality businesses that can grow earnings. And of course, that's consistent with this kind of idea of a negative momentum rally, or like worse the first catch up. We're seeing that these are all related ideas that confirm one another.
Yep.
Where should we go next?
If you could hand me the screen, I would like to wrap up consumer discretionary, because I have a final charts from Goldman. Can you see my screen?
Here we go. Let's add to the stage. Boom. Go ahead.
Yeah. If you could scroll up a bit. Here.
There you go.
Yeah, so here we are. So to validate my point on that the consumer is not actually as weak as we have been thinking, and as the data has shown, especially looking to the future data. Here you can see a chart from Goldman. I'll zoom in. So the consumer strength picked up in June. This is both good for instance, Lulu and ULTA, as well as, what did we discuss? Nike. What other one did we have? Lulu, Nike.
Starbucks, Dick's Sporting Good. I guess you can just a bunch of these. AOS.
So what's interesting here is that the real consumer spending growth, and then especially the Goldman Sachs forecast, is expected to grow in the second half of 2024. And then when we move over to the next chart, you can see that the consumption growth is likely to continue thanks to the real income growth and a positive wealth effect. Both these two things are very interesting for.
Two quick takes. So one is, I don't put much credence in like the Goldman forecast. Most of these economic forecasts are not really useful. But what I find interesting is that we see an improvement in that narrative versus what we've come in the last 6 months, where economists have been on the wrong side of expectations. So that's the Citigroup economic surprise combined with that chart, which is saying, hey, we're actually seeing improvement. That bottom chart I thought was very helpful too. Actually, that's the key point, right? You are seeing earnings growth both at the corporate level and at the consumer level.
Yeah.
Consumers have strong balance sheets. It is a two-tiered economy, no doubt about it. But Yeah, I think that bodes well for the longevity of the bull market.
I think that wraps up discretionary as well. And should we touch on China a little bit?
Sure. Let's talk about China. What do we want to
Uh,
say?
so can you see my screen again or not?
Yes, go ahead.
Perfect. So today on our call, we were talking about the effect of Trump and China and how much one man could actually impact the economy of a huge nation such as China and its markets in particular, because that's what we care about. Then I did some research because here I got a chart of the FXI. It's the China ETF with some companies in there. When you look at the FXI, you can see its peak was at the 17th of May. So I did some research. I asked Perplexity what was the most important news in the United States on May the 17th this year. And the first point it actually brought up was Trump's criminal hush money trial. So you can see how funny actually the timing is of Trump's news and the way the FXI and the Chinese markets are moving. And I think that's a very interesting point. And data.
There's quite a few data points like that, by the way. Jim Bianco was on Bloomberg today saying there's no such thing as a Trump bump. I think he's flat out wrong. I'll give you another example. And this is the event that clued me into this phenomena. We wrote about it back in February. Now it's consensus. People assume there's a Trump bump, which I think is accurate. Back in February, when Trump won the Iowa straw poll, when it was reported, you saw China dump 4 or 5%.
Yeah.
So that's just another example of that happening. So I think there's quite a few of these examples now. When after the first debate between Trump and Biden, and I wrote on Twitter, I said, expect energy to ramp tomorrow. Why? Because energy would benefit from a Trump administration, including lifting restrictions on natural gas exports, which would impact Sheneri, ticker LNG, which is one of our calls. That's exactly what happened. Everything cycles down. So that's direct evidence, of a Trump bump. If you can make a prediction and that's consistent with your theory, that's not falsified, that's called science. So I think Jim is wrong on this. What else? Let's go to the next topic.
Yeah. What was interesting, this is the intraday return. So this is this week, but we also saw this last week that the reversal factor continues to perform. And for the people to explain the reversal factor from top of my mind is the performance of a stock of the past 3 months, right? And then the performance to the upside, if I'm correct.
Right. Is this a weekly view or what time frame was this?
It's intraday.
Oh, intraday. Interesting. All right. Yeah, we should look at it. I know we do look at the longer term views too, and it would tell you the same story, the 3-month view. But yeah, the reversal factor says it measures a stock's exposure to a factor, and it's telling you the return on stocks. Essentially, like the headline is this: stocks that were smashed are rallying, stocks that are rallying are getting smashed. That's what this is telling us. Which is consistent with what we're seeing in different parts of the market, right? Like semiconductors, were correcting last week, and small caps have been rallying last week. That's consistent with what that chart is telling you. In fact, it's a dominant factor in the markets right now. So that's quite interesting. And that's why I like the idea of like consumer discretionary, because if that reversal factor happens, it should participate. It hasn't quite yet. Small caps have, right? I expect that they will.
Yeah.
What else?
So shorts, hedges, everything that did work the last 2 days of the market, so Thursday, Friday, but didn't work at all the few days ahead of that. According to us, the shorts that performed well though were restaurants and software companies. And here I have an example of a great short on Chipotle Mexican Grill. Besides that, this is a technical setup which the people who are interested could take a quick look at this or a screenshot or whatever. But Chipotle was also a very interesting short from the valuation perspective, because the valuations for Chipotle Mexican Grill were actually getting very, very high.
Share my screen right there too. Yeah, it's easier to see. I think on this screen you can see Chipotle. We talked about before they reported earnings that this thing is more expensive than Nvidia. Fun fact: Chipotle is still more expensive than Nvidia. How about that? I mean, it's kind of amazing, right? That's the power of the momentum factor. By the way, keeps going and going and going and going. But when momentum flips to negative, then you can get a vicious drawdown, like you see here.
That has happened. Actually, momentum has flipped like I think like a week ago. I have it here on the screen. If I may share my screen, you can see that here. So momentum is rolling over, negative momentum slowing down with Apple and Tesla retracing. This is a note about this week, but this is the most important part, that the momentum factor is rolling over. You can see that in this chart. So this chart dates back all the way to 2008 and prior. And this is where we are currently. And you can see that momentum was actually reaching the second standard deviation. So it was also due for a rollover, but you can see it has been hanging in there for quite some time. And okay, this is nice data, but how could you reflect on this? Well, as Ram said, momentum stocks like Chipotle Mexican Grill that have worked for quite some time are now correcting and seeing a retest, and that's literally what you see on the factor chart here as well. So that correlates perfectly with some of these momentum stocks, and also the MTUM ETF. Maybe you could share that, Ram, the way that.
Let's do it. ETF. Yes. Well, that's quite an interesting ETF.
Yeah.
Because this ETF is like the cleanest expression of the best versus the rest thematic idea, which has been working for the first 6 months of the year. This ETF contains good businesses, not all at great prices, but it does contain, I would say, good businesses. In fact, I looked at some of the holdings a few months ago. I was like, gee, like these guys have half our portfolio or something. But they have good businesses in this ETF. But you can see that factor is correct. Now, MTUM isn't a pure momentum factor expression, by the way. There are other ETFs that do that, but it is correlated to momentum. It's like, I almost want to analogize it to like S&P 500 names that have momentum. I think that's the best way to describe the MTUM ETF. It's coming at that support level right now. So we'll see how it does. But again, notice the speed of that decline as compared to what we saw with that slow rollover in March, April of last year. It's very different. And I think the other thing that's going to confound people with this momentum factor rolling over is that one of the biggest drivers of momentum is NVIDIA. And NVIDIA is growing on legitimate earnings growth. So as long as NVIDIA keeps growing with legitimate earnings growth, then NVIDIA's contribution to the momentum factor, which is significant due to the cap, will continue to remain elevated. However, we are seeing breakdowns in other names that have high momentum, but do not have earnings to support the valuation. A good example of that is Chipotle Mexican Grill.
Yeah.
So said another way, if you take the best versus the rest theme, this is a theme I wrote about, I don't know, in Q1 sometime. If you look inside that theme, meaning looking at names within this MTUM factor, names that can deliver earnings growth and are still valued kind of reasonably, I think they're going to continue to outperform. They can continue to do well. I think even momentum rolls over. If you have a correction, of course, it'll, the tide will hit them too, but not as much. In fact, we've seen like NVIDIA outperform on the downside relative to other semiconductors. Is there an easy way to show that?
Yeah, if you let me share my screen.
Sure. Well, this is a good. I love this table. It's a great table you were on before. Go ahead. Yeah.
This one.
No, I'll show it. I'll show it later. Go ahead. Yeah.
Okay. You mean the bespoke table, right? This one.
Yeah. Show what you wanted to show. Go ahead. Yeah.
Yeah. So I wanted to talk a little bit about the correlation and the confirmation of that discorrelation between tech and energy. because Ram has spoken a lot of times about the discorrelation between tech and energy, right, Ram? That
Yes.
when we've seen a rally in tech, we've seen a little bit of downside on the energy side, and the other way around. So now tech has been correcting and we've seen energy going up. So to put that in perspective, when we look over here, we can see that the past week, so that's last week, energy actually had a 2% move to the upside, while technology had a minus 5.5% correction. So I think that's very interesting, because usually when tech corrects, you see many other things, many other sectors go down with it as well, despite energy. And right here, that point is proven once again. Then another point on the, go ahead.
No, go ahead. Yeah, it's like a negative correlation between tech and
Yeah.
energy, right? The tech is the future, it's the virtual, it's the high valuation, it's cash flows tomorrow. Energy is the opposite. It's the commodity, it's the real. Cash flows are here and now today. It's also the cheapest sector in the S&P 500.
Yeah,
so
that's
that's
true.
diametrically opposed factors. That's the reason why together they can make for a good barbell. They both have positive expectancy, but because they're negatively correlated, it creates a balance in the portfolio.
Yeah, that's the most important thing, I think. The balance in the portfolio, because you're both still in a long position, but you're also kind of hedging against one another without the need of taking shorts to hedge either your energy positions or your tech positions.
Right.
So that's a great diversification. Then two other points on this bespoke chart, and then you can go address your point. I wanted to note that you can see here the difference between the S&P 500 growth, the small cap 600 growth, and the small cap 600 value. Because what's interesting, in my opinion, last week is that we saw growth correct and value actually moving to the upside. You can see that difference here and here. And then the most important thing is actually that small cap value outperformed small cap growth, in my opinion. So on the small cap side, you can see that the rotation to from large caps to small caps has worked. And then within that rotation, the better play would have been rotating from growth to value.
Yeah, I agree. This is a theme we've been talking about for the last, I'd say 2 or 3 months. The Mr. Market wants value. I'll share another screen that shows this point too. This is a comparison of S&P growth divided by value. And when this is going up, growth stocks outperform. When this is going down, value stocks outperform. This peak here is the 2021 peak, by the way. What outperformed here? Berkshire Hathaway in 2022 bear market, right? What also outperformed in the 2022 bear market? Energy stocks. Why? Because they both have value. So you can see that as well. We got carried away, not Lumina, but the public got carried away throwing call options on the Mag 7 names. Look at that. And that's what we're facing now too. I think the other conclusion you can make from this is breadth expansion, because these growth names, it's primarily like 7 and semiconductor ideas. It's a couple dozen stocks. Include like SAS, which I think remain in the dumps. But value names are much broader. So this is consistent with our breadth expansion thesis. If there's no recession, then that thesis should continue, because earnings growth will broaden, especially as you get Fed rate. A lot of folks have high interest expense and they have trouble refinancing their debt. They're hanging on by a thread. So that's what we're seeing. That's a good sign, for the market to get that breadth expansion, broader participation. It's another reason why I think we're setting up for a strong year-end price target for the S&P that I think is going to be higher than most people expect, notwithstanding the seasonal weakness that I think we get August, September, because we did ourselves. What else?
I would like to go for a few minutes over semis and their correlation with call and put ratios and their correlation with the 10-year.
Sure, let's do it.
Okay. Yeah, everyone can see my screen now. Okay, so this is TradingView. So I've done a little bit of research together with another analyst, and I came to the we came to the conclusion that this is the current standpoint of semis, and that semis are still quite a bit overbought from the call to put ratio side. Because what we saw last time here at the low of this is the SMH, by the way, so it's a semiconductor ETF. What we saw at the last low of this correction, which was about a 15 to 70% ish correction, we saw that the low call put ratio chart actually bottomed, and that bottom was correlated together with the bottom of that current SMH bottom as well. And we also saw that here. And right now, the call put ratio chart is not bottoming out yet, because what does it say here? It says that the current value of the call put ratio chart is actually at 142. And then to put in perspective what that ratio was at these bottoms, it was at 71 and 88. So on that side, I'm not saying that I'm 100% sure that semis are going down more, but when we overlay this data with the past data with the current data, it would assume that semis do have more room to go from a call to put.
We don't have the same conditions we saw at prior bottoms for semiconductors, right? And by the way, so what Stein is talking about is a put call ratio. It's a good way to measure fear versus greed. When people are buying a lot of puts, there's a lot of fear. Usually you see at bottoms around there. When people buying a lot of calls, like we saw, that we wrote about last Tuesday, that can be an indication that everyone's all in, and those call options are probably going to expire worthless. It's too much greed. So yeah, look, I think this week is like where Mr. Market does like the 1-2 step. You have like a bit of a relief bounce.
Mm-hmm.
Some names are actually quite interesting now, and like look at, say, Micron, for example.
Yeah, I pulled it up as well.
Look at Micron. So, the leader in memory, which we talked about several months ago, I think is SK Hynix. Not I think we know it's SK Hynix, but there's no ADR for it. It's a South Korean-based memory manufacturer. Micron is more volatile, but this thing. Go ahead, Stein. So what are you sharing here?
What I wanted to talk about on Micron, because you said some of these charts are actually interesting already, and I agree. And I think the most interesting chart in the whole semiconductor industry at the moment today is Micron, and that has to do first of all with the percentage of correction it already had. It has already corrected more than 1/4 of its price. So the market cap that we had up here has been sliced down to minus 27%. Then what's also interesting is when we move over to Coifin, if I can quickly get that, we can check the analyst price targets. And when we see the difference between analyst price targets from all of these semis, Micron is actually the most interesting. I'll share my screen again. One second. Here. So here you can see the price targets for NVIDIA. So when is it's the most interesting time to look to get into a stock when the current price is lower than the analyst price targets, right, Ron? When the difference is...
I think it's one of the set of things to take a look at. But for Micron specifically, I'll share real quick. I mean, look at Micron. It's near the lower end of the analyst targets. Yeah. So it touched the average analyst price target, and then it didn't do too well after that. But generally, when you see it at these levels, there can be a rally. Mm-hmm. The one countervailing factor to this is that if you believe semiconductors are on a downtrend in the next 2 months, then you might be a little early. A good thing to do here is just is to titrate and use partial positions, get a foot in the door, and then reassess. Right, so it gets you stuck, and plus it's like a good form of like risk management also. Totally. But Micron's. I mean, it's like kind of like a 15 PE ratio now compared to all these other semiconductors, which are most of which are actually. There's one other semiconductor I think which is cheap and quite interesting. It's ACMR. Oh boy, look at this thing, went up 5%. So this had a Really good entry. Looks like the entire market figured that out because it's around 5%. But this semiconductor makes cleaning technology for memory manufacturers and other foundries. Think here customers potentially like Taiwan Semiconductor, the Microns of the world. Most of the revenues generated in China. So there's China-Taiwan risk. This firm, I'm sure, would trade on that initial news anyway, but the revenue is coming from China, although it's a US headquartered company. So I don't think this gets in the way of sanctions. They're not selling GPUs, they're selling like cleaning technology. You need that cleaning technology to reduce the defect rate when you manufacture chips. So this thing, it's got like a PE ratio of 13.5. I think it just had its kind of washout moment. The breakout just now, and yeah, I mean it's well below these analyst targets. It uses more working capital as a business than other semiconductors, but you know, if you have lower rates, then there's a benefit there as well. But I think that's quite an interesting play in semis. You know, ASML was the name to buy last week when it corrected so much, and we talked about that name last Wednesday. It is like a mixed picture. It's not like a back up the truck and smack this thing for like a home run.
That's why we did a partial.
Exactly. You have to titrate. You have to we believe you have to calibrate to the risk and reward and think the world.
You have to go in full clip at one time because you feel like this is the peak of bottom because it's you're never able to peak of bottom.
I mean, I think that, you know, like the consumer discretionaries have more reward relative to risk. Like I'm actually more excited about that area. You know, although the semiconductors have a much larger long-term earnings growth, you know, potential. So
I understand. Yeah, but indeed, what you say that the consumer discretionary risk reward to the upside is better than on semis when we look at the.
In terms of like narrow performance, right?
Exactly, but to come back to entering in different parts, I think it's still important to enter into discretionary into different parts because what's the negative point in discretionary? The fact that we've been downtrending, and if we're wrong in our analysis, it will keep downtrending, and then you don't have as much of a problem when you have done partial positions instead of just going in full at once. It's just risk management. So that's what we're also very, very keen on.
I agree. I'm going to share the screen now too. This is the table that shows various sector ETFs, and it shows the price on March 28th and April 19th. The correction that took place during the springtime, if you remember, that bottomed around April 24th, or call it like April 19th, that's what we're using here. We measure the PE ratio on the 28th of March and the PE ratio at the end of April, and we show the change in that multiple. Obviously, during a correction, you get multiple compressions. You can see here. And then we show the current PE as of today and how that PE has changed since call it like the last peak before the correction. So there are a few things to highlight here. So one is home builders are 17% cheaper than they were a few months ago.
Yeah.
That's quite interesting, right? The current P is 13.9.
Impulse.
Right.
And rally. Yeah.
Exactly. And despite that small cap rally that we just seen, which has lifted a bunch of these, right? And then the PE back in March 28th was 16.8. And prices are only like 1 point higher for March 28th. That's quite interesting to take a look at. The carry index, it's like the opposite. I put this in red, actually. I put this in this more expensive to March 28th. Let me share my screen here and talk about the KRE index just briefly. So it's had a nice rally with that breadth expansion that we're talking about, right?
Exactly what you're going to talk about.
Right.
Ron, can you hear me? I think you lost connection, or I did.
All right, I'm back. Sorry
Yeah.
about that. My browser self-terminated.
No problem.
I'm gonna blame CrowdStrike on that one. So
You wanted to pull up a regional bank ETF chart.
yeah, let's pull up the KRE chart there. So hopefully you get them entertained, Stein, in the meantime. But you know what I'm about to show right now. So KRE. By the way, almost all the sectors in the green except consumer staples and energy, right? So yeah, there's these are smaller banks. They're banks that got whacked during the March-April banking crisis. They haven't really recovered, unlike the mega cap banks, such as like the JP Morgans of the world, right? But like I would not want to be buying like regional banks or community banks here. Maybe it breaks out, but it's not what I would be focused on right now. It's also this is an uptrend, no question about it, right? So, but risk reward there doesn't look too interesting. Any other concluding thoughts? I'm gonna take a look at some of my notes. Yeah, so like highlights, I think tech starts off the week strong. We're seeing that now. Small caps take a breather. That include like names in the KRE index. We like the risk reward for small caps due to the good fundamentals story around that, earnings growth, and also the technical breadth for us we talked about at the top of the call. Also meaning that the market's not reacting to positive earnings beats. We've seen that with now Wells Fargo, ASML, Taiwan Semiconductor. So this is a market that's ahead of itself on expectations. So we're in like an improvement mode. So you don't want to be aggressive ahead of earnings. You want to wait for dislocations and then go buy into dislocations the names that you have strong views on that you've already researched, right? By the way, LPLA I wrote about this week. We put a buy on LPLA. I think this is quite interesting. Like it's getting caught up in issues around Schwab and how Schwab makes money on client cash balances, which is really egregious. Schwab changing that policy. I mean, it's like it's been the cheap since 2022. It's a bigger business. The PE ratio is 12.9. It was like in the high teens a few weeks ago. So, yeah, I like that. I like that position. I'm not going to walk you through the entire thesis here. You can check out our newsletter for that. I expect in a year this is going to.
Yeah, exactly. I think the most important thing is patience. Patience is needed.
Yeah, this will be like double digits.
You should
I
not
expect
that when you hit a buy button that you're up 10% the next morning.
Exactly. This is not going to be like a Momo stock, like a semiconductor, where every month you think you're going to be a stock like that. It'll be volatile. It's going to rally, then tank again, and try to shake you up. But let me look at like CVS. By the way, CVS
it's down
13 or 14% since we initially bought it. But the general point here is this. The general point is this. Like, take a step back on CVS, right? This thing also tanked. I'm not going to walk through the CVS thesis. We've written about that, talked about that before. Yeah, like you had a rally, then a little out here, then a rally again, but it has to. So that's the kind of behavior I expect out of LPLA. I mean, CVS is like the 4P is 8. Usually it's in the low teens. This is quite something. And so I expect LPLA will do well in like a year's time, if not like sooner. Just like remember buying the quality banks in the March-April banking crisis, right? We were buying JP Morgan, UBS. Let's look at JP Morgan. I mean, this thing is up like what 60% since the banking crisis. You can see my screen there. I write where we wrote on Twitter. We said we bought it. That was around $127. The thing is like $210. This is a bank. It's a bank. What's 210 divided by 127? It's a lot.
Yeah.
So you don't need to own tech stocks to do well in investing, right? Buy the quality asset that's on sale. And what's been nice about this market is like every quarter, there's some other category that gets whacked, and it's not necessarily for fundamental news, and that's creating nice opportunities. You can't predict what they are, but you don't have to predict. You can just play the hand that's right in front of you.
Yep.
Find the quality value names.
And get in position and have patience.
Exactly. Well, I think we can call it a wrap there. Anything else? Maybe. Oh,
quickly cover. Yeah, quickly cover crypto. I was about to say the same.
Yeah, let's go there. So, we bought this, which gives exposure to Bitcoin, Ethereum, and Solana. It also has a discount to NAV, which is a nice kind of margin of safety component to it.
Mm-hmm.
Yeah, this is done real nice, right? At like $24. And you can look online when we bought it, but it's like a double-digit percent. Definitely had to skip our heartbeat a few times though in Germany. Started doing like max sell Bitcoin.
Yeah.
Look, the catalysts are pretty simple. You have an Ethereum ETF. You've got Trump who's going to speak at the Bitcoin conference in a few days. This isn't a bad time though to like sell like a quarter of the position. Why not? It's good risk management, lock in a gain.
Surely it's so important to just get some profits, to get them off the table, have them back, have the ability to rotate those profits around the portfolio. And besides that, ahead of such news events, I think a lot of it is priced in. I mean, we could see some bumps, but it's always important to take profits when such news in crypto landscape is coming ahead of you.
Right. Well, I'll say like tax considerations definitely matter. And look, we want to see what the announcements include. Like, does Trump announce a strategic Bitcoin reserve or who knows what? Right? Now, that'll be narrative, not fundamentals, because you need an act of Congress to make that happen.
Yeah.
Right. So that's something to keep in mind there.
So we're wrapping up with ASPI.
Yeah, uranium in general, I think it's quite interesting. ASPI is an advanced materials business that touches uranium, but also touches healthcare. If you look at uranium, look at, this is URA. That's not a bad entry, right? It's not a bad entry. It's at the 200-day moving average. If you take a look at the competitors to ASPI, which is a name we own. What's the ticker for Silex? Silex Systems. There we go. It's like silky, except with an X. Yeah, it looks like it's presenting an entry. Look at another one. My point here isn't those securities, but it's a good way to triangulate around how you think about like ASPI. So it's not bad either. I think the levels here are good. We bought some more today. Look at that. It's around the 200-day moving average 2. That's a good entry. That's a good entry. So let's see how that does. It does have a lot of momentum. That's something to be cognizant of. So when momentum is fading, this can get caught in
exactly
currents, right? Materials we saw on that flows chart, materials is benefiting from inflows. No one's talking about that also. So the materials ETF has been doing pretty well. I think we can wrap it up there. I don't know, Stein, if there's anything else you want to share there. So you got a slide, you got a chart.
This was it. Yeah, Nike. Just been charting Nike. That's it. No, this was it from me, from my end.
Terrific. Well, we'll call it a wrap. Thank you all for joining. Be sure to ask questions and we can comment on those too. All right. Take care, everyone. Be well now. Bye-bye.
Bye-bye.